Let's start with the rule. Now, this is not a formal law written in the Federal Reserve Act. It is more like an institutional norm. The Fed usually tries to maintain a unified front. Why? Because monetary policy is not just about the interest rate itself. It is also about expectations. If investors, businesses, banks, and households believe the Fed is coherent and coordinated, they respond in a more orderly way. Bond markets stay anchored. Rate expectations stay manageable. Financial conditions move in a smoother direction. That is why, historically, the Fed has preferred to signal carefully, move gradually, and avoid public fragmentation unless absolutely necessary. But over this cycle, that norm has weakened badly. Reuters noted in late 2025 that the FOMC had not seen 3 or more dissents at a meeting since 2019, and that a fresh flurry of disagreement could pose both market and political risks. At the same time, recent Wall Street Journal reporting describes Powell's final meetings as chair as some of the most visibly divided of his tenure, with Trump-appointed governors increasingly willing to dissent openly. So the rule that has been broken is this: the Fed is no longer reliably protecting the appearance of internal consensus. And in markets, that is a huge deal, because once consensus breaks, the Fed's message gets noisier, weaker, and harder to price. Let's talk about the evidence. In September 2025, the Fed cut rates by 25 basis points, but there was already a dissent from Stephen Miron, who wanted a bigger half-point cut. Then in October 2025, the Fed cut again by 25 basis points, but this time the disagreement came from both directions. Miron wanted a larger cut, while Jeffrey Schmid preferred no change at all. That is important because it showed the committee was not merely debating speed. It was debating the entire policy stance. Then in December 2025, the split got even louder. The official statement shows 3 dissents. Stephen Miron wanted a bigger cut, while Austin Goolsbee and Jeffrey Schmid preferred to hold rates steady instead. That was the kind of fractured vote the Fed had not experienced in years. Then in January 2026, the Fed held rates at 3.5% to 3.75%, but again there were 2 dissents. Miron and Christopher Waller wanted a quarter-point cut immediately. So think about what that sequence tells us. This is no longer a normal debate around tiny tactical adjustments. This is a deeper fracture over what the economy actually is right now. Is inflation still the main threat? Is growth weakening faster than expected? Should the Fed protect credibility or protect employment? Is energy inflation temporary or the start of a second inflation wave? Those are not cosmetic disagreements. Those are worldview disagreements. And when a central bank starts having worldview disagreements in public, markets interpret that as policy instability. A lot of people hear dissent and think, okay, internal democracy, what's the big problem? The problem is that the Fed depends heavily on forward guidance. When the Fed is unified, markets can say, we may not like the policy, but we understand the reaction function. When the Fed becomes divided, markets start asking, which faction is winning? Is Powell still in control? Are dissents becoming political? Are rate cuts still coming? Could hikes come back? Is the Fed reacting to data or to pressure? That is when volatility rises. Reuters reported this week that some investors now fear even rate hike talk returning to the table, because oil-driven inflation has changed the conversation. At the same time, other analysts still think the Fed may eventually need to cut if labor market weakness deepens or private credit stress worsens. In other words, the market is being forced to price multiple contradictory futures at the same time. And that is exactly what a policy shock environment looks like. Not just when the Fed surprises markets once, but when the Fed becomes structurally harder to interpret. Now let's talk about why this internal division is happening right now. The biggest reason is that the Fed may be confronting a new inflation problem. Not a demand-driven inflation story like the post-pandemic surge. A supply shock inflation story. In March 2026, the Middle East conflict has pushed Brent crude above $100 per barrel, with multiple reports linking the move to disruptions tied to Iran and the Strait of Hormuz. Reuters, AP, and other major outlets have all described the oil spike as a new complication for the Fed, because it raises inflation risk at exactly the moment growth is softening. That is the worst kind of setup for a central bank. Because if growth slows, the Fed normally cuts. But if inflation reaccelerates, the Fed normally stays tight. And if both happen together, you get the word nobody wants to hear: stagflation. That is why Reuters said the March meeting could force the Fed to confront a more symmetric stance again, where hikes are not the base case, but also cannot be ruled out. So the Fed's dilemma now looks something like this. The labor market is softer. Growth is less secure. Political pressure for cuts is rising. But oil has surged. Inflation may stop improving. And the Fed cannot afford to look asleep at the wheel. That is why this feels so unstable. This is not a clean easing cycle anymore. This is a central bank getting trapped between a weakening economy and a geopolitical inflation shock. As of the Fed's January 2026 decision, the federal funds target range is 3.5% to 3.75%. That remains the official benchmark heading into the current March meeting window. And this is where things become especially interesting. Markets were previously expecting a smoother path to further cuts in 2026. But in recent days, that confidence has faded. Reuters reported that some brokerages pushed expected cuts further out, with Barclays moving its first projected 2026 cut from June to September, while traders scaled back expectations for how much easing will happen at all. So here is the market's problem. The Fed already cut in late 2025, but it never sounded fully dovish. Then oil exploded higher. Then internal dissents increased. And now nobody is sure whether the easing cycle is merely paused or effectively over. That is the confusion. This is why the same Fed can look dovish in one headline and hawkish in the next. Hold rates steady? Hawkish if inflation is rising. Keep cuts on the table? Dovish if growth is weakening. Refuse to commit? Volatility for everyone. And when both bonds and equities struggle to interpret the same message, that usually means policy communication is failing. This environment explains the strange cross-market behavior we are seeing. Gold has been trading at exceptionally elevated levels this year. Reuters reported gold above $5,200 in late January at record highs, though by March 18th spot gold had pulled back closer to $4,987 per ounce as traders worried the Fed could stay tighter for longer. That tells you something important. Gold is not just reacting to rate cuts. It is reacting to policy distrust, geopolitical instability, and inflation uncertainty. Meanwhile, in rates markets, investors have reduced bets on near-term easing because higher oil prices could feed broader inflation. And in equities, the fear is that the Fed may not be able to rescue growth as quickly as investors once hoped. Reuters and AP both described recent market moves as a reaction to the collision of oil shock, weaker growth, and reduced confidence in fast Fed easing. So if you want the one-line summary, markets are no longer trading one macro story. They are trading three stories at once. Story 1, inflation could come back. Story 2, growth could weaken. Story 3, the Fed itself may be internally unstable during a leadership transition. That combination is why this is so explosive. Now we get to the political angle. Jerome Powell's term as Fed chair ends on May 15, 2026. The Wall Street Journal notes that this March meeting is effectively the penultimate one before that deadline. And President Trump has nominated Kevin Warsh to succeed Powell, though reporting indicates the confirmation process is not fully settled and could become messy. Barron's reported today that if Warsh is not confirmed by May 15th, there could be operational uncertainty around the transition, even if institutional continuity remains intact. This matters for two reasons. First, transitions are always sensitive. Markets do not like uncertainty at the top of the world's most important central bank. Second, the current internal dissents are not happening in a vacuum. They are occurring while the White House publicly pressures the Fed to cut. Reuters reported just days ago that President Trump called for a special Fed meeting to reduce rates right now. So put all of that together. Powell is nearing the end of his chairmanship. The committee is visibly divided. Political pressure is explicit. A new chair could arrive soon. Markets are trying to guess whether the next Fed will be tougher, softer, or simply more political. That is not normal Fed plumbing. That is regime shift territory. So where does this go next? I think there are three big scenarios to watch. Scenario 1, the hawkish hold. The Fed keeps rates where they are, refuses to signal imminent cuts, and emphasizes inflation risk from oil and tariffs. That supports the dollar, pressures rate-sensitive stocks, and keeps bonds under stress. This is basically the higher for longer, but without saying hike scenario. Scenario 2, the profitable shock. Growth weakens faster, labor conditions worsen, or some financial accident hits credit markets. Then the Fed pivots more aggressively than investors currently expect. This is the kind of sudden easing shock some analysts say markets are underpricing. Scenario 3, the credibility crisis. The most dangerous one. The Fed stays divided. Messaging remains inconsistent. Oil keeps inflation elevated. And the leadership transition adds more uncertainty. In that world, markets do not get clarity. They get churn. Stocks, bonds, gold, and the dollar all start reacting more to Fed politics than to clean macro fundamentals. And honestly, that third scenario is why this story matters so much. Because the real risk may not be one bad decision. It may be the disappearance of a reliable framework. So, did the Fed literally break a written rule? No. But it may have broken something almost as important. The market's belief that the Fed will always defend internal consensus when the stakes are highest. And once that belief starts fading, every policy meeting becomes more dangerous. Because investors are no longer just asking, what will the Fed do? They are asking, which Fed are we even listening to? The hawks? The cutters? The inflation fighters? The growth protectors? The outgoing chair? Or the incoming regime? That is why this moment feels different. This is no longer just a rate story. It is a credibility story. A transition story, a shock story. And if the Fed cannot restore clarity soon, 2026 may be remembered not as the year of the next cut or the next hike, but as the year the market stopped hearing one central bank and started hearing a committee at war with itself.